What does stop hunting mean? So stop hunting is a strategy employed by market makers to force some market participants out of their positions by driving the price of an asset to a level where many traders have chosen to set their stop loss orders. Stay tuned and I'll show you exactly how to avoid this. So, is stop hunting why your trade loss is getting triggered? Now, it could be, but we need to look at several more factors to be sure because there's a lot going on with trading. Some likely reasons your stop loss got triggered other than stop hunting could be that before you entered your trade, did you consider the vibes? Now this stands for volatility, intent, bounce point, entry, and stretch. If you set stop losses within the volatility of the current market conditions, it's no wonder your stop losses are being triggered. If you started your trade with no plan, there are two simple reasons your stops got triggered. Now the first one is greed. Setting a tight stop increases potential R multiple on each trade. That also makes it really easy for your trade to get stopped out. Now the second reason is inexperience. When setting stops when setting stops super close to your entry, this usually means you haven't tested your strategy enough and don't understand the best place to put your stop loss. Now here's where you need to set your stops. To well optimize your stop losses, we need to look mostly at three places within the vibe framework. These are the volatility, intent, and stretch. We will take a look at each of them to create the best stops for your trade. Now first, we'll look at volatility. There are essentially two types of markets. We have the ranging market and the trending market. Now this next photo is an example of a high volatility ranging market, as you can see by the huge ups and downs. And you clearly would not want any trades inside this market because of the uncertainty and volatility within it. Now, here's a low volatility trending market. Due to the low volatility within this next image, trades taken during this trend could have been taken with very tight stops, and you would certainly have profited if you traded within this, and you would have risked very little. Now the second thing we look at is intent. When setting stop losses, you must ask yourself what direction the market wants to go in. Is it moving in an obvious direction, or are you simply guessing where you want it to go or where you think it may go? Now, try to work with the intent of the market, generally based on previous price action. Now, in this next photo, the current candle is another strong move in the downward direction. With this current information, what's the likely intent of price action? Now, you probably said the price would probably move down more from here, so you would have opened a short or you would have not long the position. And when we move the chart forward, we can see that this assessment of intent was correct, and you would have either profited from your short or lost greatly from your long. Now the last thing we look at is stretch. Stretch can help you a lot when choosing where to enter a trade. Price action behaves much like a rubber band. If you stretch it far enough against the directional intent, it'll snap back hard and make it much easier for you to profit. Ideally, you want to trade in low volatility conditions and should be trading with the intent of the market. Now in this next example, you'll see a strong uptrend off a heavily defended support. Volatility is low off of the support level and there is clear intent of price to move upwards. So as you can see, a long position would have been great. Now let's look at a trend where we enter in the direction of the market intent, but there isn't enough stretch against the trend to give us a good chance of profiting. If you wanted to enter a short trade at the blue arrow with the stop losses slightly above the orange level, it's a pretty good idea because the price is bouncing off of a former support level turned resistance. But we have to remember that two of three criteria are working against us in this trade. So what I mean is, The trend is volatile, so entering a trade isn't ideal. You would want to set your stop losses much wider. The intent appears to be in the downward direction, so we're good here. And then there isn't much stretch in the upward direction to make this trade a high probability trade. So, as you can see, waiting for a good stretch against the direction you want to enter a trade can be a great way to increase the reward to risk ratio of your trade and give you a better chance of not getting stopped out. So, in conclusion, if it seems like you're getting stopped out way too often because your stop losses are too tight, then we hope this video helped you understand your issues and how to fix them and start profiting more. Thank you for watching. Please like and subscribe the video if you enjoyed it. And remember, successful trading involves both wins and losses.